Hello and welcome to Cafe Mutual YouTube channel. I am Nishant Patnaik, Associate Editor, Cafe Mutual. SEBI data shows that the AUM of alternative investment funds and PMS has grown by 37% over the last 1 year, while the AUM of AIF grew by 36% to reach 11.34 lakh crore as on March 2024. The PMS industry recorded 40% growth to reach AUM of 6.70 lakh crore if we exclude the APFO contribution. So, to shed light on this growth and give us more insights on the world of alternatives, today we have with us Sushant Bhansali, CEO, Ambit Asset Management. Sushant has over 2 decades of experience in PMS and AI space. So, without wasting time, let's invite Sushant. Welcome to the show, Sushant.
Thanks, Nishant. Thanks for calling me here.
Sushant, I will start with a Q&A on equity markets. So while the
Sure.
markets have reached all-time high, of late it is showing a somewhat downward trend largely due to external factors. However, on the domestic side, India looks stronger with healthy GDP ratio, PMI expansion, and increased export. How do you read the current state of equity markets and where it is headed in the near term?
Sure. Times are quite exciting, Nishant, in terms for equity markets. The last 4 years, there has been a massive bull rally. There was a period of consolidation between for 15, 18 months between 22 and 23. But that's all behind us. And what gives solace to this great equity bull run is that it is well supported by superb earning growth delivered by corporate India. And more companies are getting listed in this environment and giving investors to participate and in the whole India growth story. From a medium-term perspective, which in my view you can consider as 1 to 3 years, the ride looks equally eventful and good. There will be bumps in between, but the road, the direction seems to be quite clear that it is going upwards and nowhere else. It is backed by both good set of earning, which we believe the companies will deliver, both from export perspective as well as great consumption within the country as per capita GDP rises for constituents here in this country. And also by increasing financialization of saving, whereby each and every saving is now increasingly becoming slave of financial products and not necessarily traditional products like of real assets. So that I would say a combination of good earning with good participation in financial assets will lead to a good economic growth for equity markets as well.
Okay. Sushant, many people believe that the market is valuation across market capitalization are very high at this moment. But what is your view on this?
Yeah, there will be always temporarily ups and downs on valuations. As more liquidity increases, the valuations will always rise. Having said that, they do adjust themselves over a period of time, and which is what we are seeing. If the multiples of few companies were very high about a year back, they are not that high anymore, right? At the same time, there are new stories which are getting discovered every month, every quarter by investors. And the good part about this rally in the last 4 years is that there are more legs to the story. There are many more companies participating. The both earnings as well as market capitalization increase has been more widespread than it was in the previous 5 years. The returns are much more diversified than concentrated in the previous 5 years, in the last 5 years. So that trend, I would say, is quite healthy, and one doesn't need to worry about unless the view is and the risk-taking capability is for a few weeks or months and not for quarters and years.
Okay. On extension to this question, Sushant, equity market are scaling all-time high. So how should wealth managers deal with the lump sum inflow?
Yeah, so it's about, I think, wealth management is more about asset allocation than about trying to time the market. You need to get the asset allocation right. And if the advisor believes that the valuations are punchy, or if the wealth advisor believes there's an opportunity, they have to play the allocations. You need to be present in all asset classes, and you need to allocate the client's money across these different asset classes in different proportion at different points of time. One can take also in regard the liquidity needs of the client. as well as the risk capability and risk taking ability of the client to come out with a solution which serves the client's need. As
Okay.
far as the lump sum versus SIP investments are concerned, I would say depending on various factors, the solution will be different for different clients. And for a new investor, a lump sum will not mean much in terms of taking a higher risk, while for an old seasoned investors already invested heavily and have a large equity allocation, lump sum might be a bit more than an SIP, probably might be a better way to do things.
Okay. Sushant, equity PMS and CAT3 AIFs are somewhat similar to mutual funds. Then why do you think that PMS and AIF offer diversification to investors' portfolio?
In our view, they are actually very different products than mutual funds. Mutual funds, the and in various means and shape. If you look at from an investor base, mutual funds is for primarily for retail investors, or rather any investor, while PMS, AIFs are more for high net worth individuals and more sophisticated investors, and probably the next step in your investing journey. Mutual fund is probably the beginning of the journey. So they are very different, and each product has its own merits in terms of why investors should invest into those products. And AIF and PMS have their own, I would say, sophistication and need, which attracts investors to these products generally.
Okay. So Sushant, under what circumstances should equity PMS and CAT3 AIF be recommended to clients?
Yeah, so depending on where the clients are there in their investment journey is where I would say the need for AIF PMS will arise. For investors who already have seen the investing journey and have and are able to digest the volatility of equity markets, PMS and AIFs are the next step in terms of getting probably if you look at from especially if PMS, if I talked about compared to mutual funds, then PMS is for the knowledge-based investor who would like to know what is behind the numbers, who would like to know how the returns are generated, who would like to participate in a particular sort of set of things in terms of how they want to get the part of their investing side much more vibrant. Mutual funds typically will offer plain vanilla products which can work for everybody and for all points of time. While PMS will be for people who want sophistication, who want to play a particular theme, who want to like and back a young manager or a very experienced manager with less regulatory constraint. Because so in a I would say simple phrase, I would say PMS AIFs are more for the evolved investors, while mutual funds are the first step towards the investment journey.
Okay, so one last question, Sushant. There are many strategies in PMS and AIFs. How can wealth managers shortlist PMS and AIF for their clients?
Yeah, again, like there are so many options available for wealth managers to choose from when they look at mutual funds, and probably there are many more mutual fund schemes to choose, and it is a very difficult job. But they have mastered the art on which are the right products for a particular client. Not the same product will be right for all the clients, so one will do their own research and figure out which is the right product for the right client. Similarly, in the PMS, there are few things one will need to look and figure out which is the right product for a set of clients and offer them those products. The various things one can look at while figuring out what's the right product for a right set of clients will be, I would say, looking at the concentration of the number of stocks in the portfolio, looking at their returns across market cycles and not necessarily point to point returns, because a PMS will be more specific and not a diversified pool where all styles will be available. Within a mutual funds, you will typically see bearing few schemes that each scheme will have some value, some growth, some momentum, etc., etc. While PMS is not that, PMS will be either it will be a value style, or it will be a growth style, or it will be, let's say, momentum style, and many much such more themes. So one need to do more of homework, and what is the type of solution you want to give to your client. So if the client is already into mutual funds or into direct equity stocks, what is that the advisor would want to make as part of their portfolio playing through the PMS. And depending on that need is how you will shortlist what are the strategies available from the PMS basket or from the AIF basket to fulfill that desire and that need of the client.
Okay, so with that, we have come to an end to this interesting session. Thank you so much, Sushant, for your valuable time and inputs.
Thanks so much, Nishan. Thanks, Cafe Mutual. Hope you have a great event at the first Alt conference later this month.
Great,
Thank
great.
you.
Yes. And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. And please join our event on August 23rd, Cafe Mutual Cafe Alt Conference, which is happening in Mumbai, Taj Lands End. Bye-bye.